Welcome back to Profit Punch. I've been looking forward to making this video. It's how to use leverage ETFs to make consistent profits. You're going to master how to get compounded returns when there's a very strong trend in the market, and also how to use leverage ETFs to know when the market is going to turn against you. So a leverage ETF is an ETF that promises a leveraged move on the daily chart of a certain commodity. So if a stock like Apple goes up 1%, then a 2 times leverage Apple ETF promises to give you 2% on that day when Apple moves 1%. So since it's a daily promise, this is where the magic happens. So the first thing I want you to understand is the power of daily compounding. Since it's a daily promise, that means that over time, the 2 times ETF over several days, if Apple goes up 1% over 40 days in a row, the 2 times ETF looks like it should go up 80%. If Apple goes up 40%, it looks like the 2 times ETF should go up 80%, but that's not the case. It actually goes up more. So here in my example, if a normal stock goes up 5% a day, and then the 2 times ETF moves 10% daily, then what's so funny is that in 20 days, the normal stock will have a 165% return. So you'd expect the ETF to have twice of this, which is about 330% return. But no, over 20 days, the 2 times ETF will have a 572% return. So this is where the magic happens, this compounding over time. So if this happens over even more days, then you're going to be getting a much bigger profit. So you can see at day 20, if the daily stock has been moving up for 5% per day, after 20 days, the 2 times ETF is actually going to be 3.5 times, it's going to have a 3.5 times return of the underlying stock. And if this increases over 40 days, the times 2 ETF is going to have a 6.5 times return over the normal stock, and it's not 2 times. So this is where a lot of money can be made. This is a trick which I accidentally found when I was trying to compare the returns over time, and it didn't make sense. The 2 times ETF was giving a much better return. And then I finally figured out why it was doing this. Now, before we go into how to get those great returns, I also want to tell you that inverse ETFs are leading indicators. So what is an inverse ETF? An inverse ETF is when, if Apple moves up 1%, then the inverse ETF will move down 1%. So it's going to have -1. So if it's a inverse leverage ETF, if Apple stock is going up, inverse ETF is going down. If Apple stock is going down, inverse ETF is going up. So they're inverted. But what's really interesting is that this inverse ETF has a clearer graph, and then if you look at it on the chart like I'm going to show you, an inverse ETF will actually have a better signal to tell you when a stock has bottomed and it's time to buy. So let me show you some signals. Because in a messy market, you might not see the signal easily, but the inverse ETF, it's very easy to see the signal. And then once you see the inverse ETF falling, then you can know that, hey, the market has turned, it's time to get into this market. So here, I show you the SPXU, S&P 500 inverse ETF. So here, the S&P chart looks a little bit confusing, but if you look at the inverse chart, it seems easier to read. You can clearly see 3 lower highs, and then you can see the blue line is the 20-day simple moving average. You can see it crossing under the 50-day simple moving average, and then it looks like a clear sell on the inverse ETF. That means that you should buy the S&P 500, and you can know that the market has bottomed. Here you can see a gap up in the stock market, and then you can see it filling those gaps. Those are bearish signs, and then it tries to go up, it fails. Then there you can know that, okay, I should start shorting this inverse ETF. That means I could start buying the market. But if you look at the market on that same day, it looks like the downtrend has not yet finished. So it looks a little bit confusing, but here on the inverse ETF, it seems easier. I find inverse ETFs gives me a better signal. This is the QQQ Ultra Short ETF versus the NASDAQ index. So if you look at this ultra short, you can see lower highs, lower highs, lower highs. So that means it's getting weaker and weaker. But then the NASDAQ looks like it's forming a triple bottom, and it looks like it's really going nowhere. So here on the inverse ETF, you can see the 50-day simple moving average is trending down. So maybe this first two I wouldn't short. Maybe on the second one I could short because this looks like a double top. And then I'd start building my position in a market. And it looks quite clear here. And this last arrow I show you here is the final nail in the coffin. This is clearly a short selling setup. So that means you can know that, hey, it's okay to buy the NASDAQ. But on the NASDAQ, it looks a little bit confusing, especially this first three bottoms here. Another one that I want to show you is Bitcoin here. So you can see Bitcoin forms this based on the chart, which looks like it can be a little bit confusing to some people on the weekly chart that they don't know that, hey, these are shakeouts down here, it's time to add to your position. But if you look at the BT inverse ETF, you can see that it just has this flat line over here, and then this week it breaks down. So this is clearly a time to start buying Bitcoin. This is a very clear signal on this inverse ETF. And then if you look at this base here, it also looks a little bit confusing. But if you look here on the weekly chart of the inverse ETF, it looks very clear that it's failing on this moving average, and then it forms this double top over here on the weekly chart. This is a very strong signal, and then it comes and fails. So that's really interesting. Also right now, I'm waiting to see when this BT ETF will cross down, then I can know that it's time to buy Bitcoin. This is a very nice indicator. Then the next thing that I want you to learn is where you can make a lot of money when the market goes in your favor. This is a multi-month based strategy. Because a lot of people do day trading, but I found that if you find a stock that has been sitting for 6 to 4 months, like NVDA did in 2024, 2023, I think when it moved about 120%, you can make a lot of money. That's where you're going to be making money. You find a stock, a commodity, or a crypto that has consolidated sideways for 3 to 6 months, and then this coiling effect normally produces a lot of compound moves. So once you see that, you look for a leverage ETF, and then you start building your position into it. So this is for people who don't like to trade a lot and you just want to catch these big moves and make a lot of money. It's quite simple. Look for a coiling base. This is what Profit Punch does for you. And then for execution, you buy the leverage ETF, and then you can make a lot of money. So let's go through these examples where you can make a 100% profit from a 20% move. And then these are the examples I'm going to go through. It's quite a lot, but let's see how you can learn from this. So Bitcoin here. So here I show you the inverse ETF. So Bitcoin, you can see that here Bitcoin is bottoming, but it's easier to see it on the inverse ETF. You can see that, hey, it forms a double top, it forms a lower high, it keeps failing and failing to form higher highs, and then you can know that, hey, it's time to buy Bitcoin. And then Bitcoin went up 80%. But then remember, like we said, you don't buy Bitcoin, you buy the leverage ETF for Bitcoin. Now I show you how that same move in Bitcoin actually then led to a huge profit. So here the first step is finding the inverse ETF that shows you that, hey, I failed from higher highs and I keep failing and I keep falling down. Then when it's time to buy, this red arrow is a good time to add to your position or to build new position. Then when it's time to buy, you don't buy Bitcoin itself, you buy the 2x2 ETF. So Bitcoin went up 83%, so it looks like the 2x ETF should go up 160%, but the 2x ETF went up 200%, so you can see how that profit is way better than the original Bitcoin. You have to be careful though, because on the downside also this ETF will fall faster than the primary market. Here we can see MicroStrategy. So since Bitcoin is going up, MicroStrategy stock has to go up. So MicroStrategy went up 375%, as you can see. And you see, the smoother the move up, the more the leverage ETF is going to give you greater returns. That's why you want to find a stock that has sat down for a while and is ready to jump out and is ready to make a very smooth move. Because if the move is very volatile, then this leverage ETF actually does not perform as well. So here you see 375% move in MicroStrategy. We expect times 2 of that, which is about 740, I think. But you can see that this one actually did about 1,400, which is almost 4 times what MicroStrategy had given us. So you make way more money from the leverage ETF. Isn't that quite beautiful? And MicroStrategy in this particular example had sat down for about 5 to 6 months and then created this huge move. So you just have to be waiting for when that stock sets up, and then you strike when the time is right. Now onto commodities. This just doesn't happen in crypto. So we know gold had a big breakout in 2024. So I'm going to show you how the inverse ETF and how the ETFs in gold can get you a lot of money. Then silver did the same thing. So gold went up 180%, right? From 2024 to 2026. So what happened to the times 2 ETF? It went up 1,029%. This is almost 5 times, yet it is a times 2 ETF. This is the power of the compounding interest that I showed you. But why is it such a huge difference? It's also because gold is a very stable asset, and you can see the movement in gold was very smooth. The smoother the move in the primary market, which is something you cannot predict, the better the move in the times 2 ETF. Silver went up 282%, but then during that same times, the silver stock, which is AG, went up 480%. This is also something, just a special tweak for commodities. I did find that the stocks go up way faster than the primary commodity. So if silver is going up, you have to do 2 things. Look for a silver stock. So you see silver did 280%. The stock itself did 480%, which is almost a times 2 difference. Then silver itself did 282%, this big move. And why was it a big move? This was a breakout to all-time highs in silver. It had been sitting down for 4 years. So these are the type of moves where you just put in a lot of your money. You keep building your money. You keep building your position on these weekly pullbacks. And once it breaks out, all hell breaks loose. Just keep buying the times 2 ETF. Went up 1,000%. So that means your money went up times 10 at the maximum point. This is a weekly chart. Of course, you'd have sold around maybe 290. I don't know if you could have sold up here. Then I show you how silver, you could have seen from the inverse ETF that it's time to buy silver. So you see here, the chart doesn't look so beautiful on the weekly chart. It's a little bit confusing, I'll tell you that. But if you look at the times 2 ETF, which is the inverse times 2 ETF of silver, it's a very clear chart. This is sell, 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 sell. And then you see this huge fall, which coincides with this huge move up. So that's quite interesting. The reason you don't want to be shorting the inverse ETF is that you see the maximum the inverse ETF can give you is 100%, because when you're shorting, the maximum profit you can make is 100%. But when you're longing, you can make way more than 100%. Argentina stocks, this one is a little bit different, but similar to commodities. So here you can see that the Argentina ETF is going up. So what you do is just you find Argentina stocks. So this is the primary market. The Argentina ETF went up 40%. What you do is that you find the leverage ETF or find the best stocks in that particular sector or market, which is Argentina. So you see from a 40% move in the primary market, BMS stock did 120%, SUPV did 185%, YPF did 130%, GGAL did 116%. Then we're going to go to USA stocks. This can also be done on stocks. This is what makes it very beautiful. You see here NVDA, it had its 6-month base. It sat down for a while. This is where you want to be watching the stock, studying it very closely. And from such big bases, you know that if it sits for 6 months, then you know that, hey, maybe I can hold it for about 2 months. There are several selling strategies that I discuss on Profit Punch, so keep watching out for those. So NVIDIA has a maximum move of 182%, but then the 2 times ETF should have twice of that, which is 360, but no, it does 438%. Crazy. So you see, the smoother the move, the bigger the return. So who had the very smooth move with very few pullbacks? compared to NVDA, which had this huge strong pullback, which ate in the ×2 ETF profits. So Hood goes up 230%. So we expect ×2, which is 460%. But no, the ×2 ETF did 800%, which is almost ×4 of what Hood did during that same time. So one thing I learned about these very big bases is once the stock sits down for about 5 months at least, what normally happens is that it will jump out, it will pull back to the 50-day, then it will make a swing trade up again, and then it normally stops there. It's funny how it happens a lot. Look at NVIDIA as well. Jumps out, pulls back to the 50-day, makes one last push. It's quite interesting. RKLB did the same thing. Jumps out of a huge base, goes up 260%, pulls back to the 50-day, makes one last push. Then we see the ETF during that same time, the ×2 ETF did 830%. Copper stocks, I guess I'm just going to repeat what I've already showed you. It's the same stuff. The primary market is copper, goes up 33%. What happened to the HBM copper stock? Went up 91%. TGB copper stock did 120%. For commodities, you can get both the ×2 ETF and the stock on its own. Thank you. I hope you found value in this video. Sign up for the Profit Punch newsletter if you want to know when these moves happen in the market. May the markets be with you.